Suresh, good morning and thank you very much indeed for joining us. Can you exactly explain what impressed you? They earned more from distributing financial products?
Yeah, so if you were to really look at it, when we had a forecast about near before or 1.5 years before when we initiated on the date of listing, we did believe that the core business maybe not be making much amount of profitability, and whatever profits have to come will come from the third party distribution of loan products. But we really didn't anticipate the scale at which they could do it. So therefore, what has actually happened is we have actually increased the numbers by 200%. So they are actually 3 times the level at which we had earlier anticipated. And also, Lata, what has happened here is there is a thought process behind this upgrade. So just for the benefit of audience out here,
Yes.
we have checked with some of the largest partners about the quality of the portfolio which is being originated by Paytm, and actually stands rock solid. And that gave us the belief that yes, maybe there is some merit to the third-party distribution of loan products that they are doing, and therefore it definitely warrants an upgrade considering the risk-reward, where the valuations are and where the earnings projections are likely to be going forward.
Okay. You know, you've given us a lot of bar charts in terms of the number of loan transactions done, the number of loans disbursed, the value of loans disbursed. You have given us a lot of bar charts in your book. But what impressed me most is this merchant loans category. You know, their penetration of BNPL, buy now, pay later loans is 4% of their total transactions or total customer base. But merchant loans is 5.2%. Is that very impressive? Because, those would be slightly larger value loans, I would assume.
Yeah, so there is a big scope here, and they are taking 5% as a percentage of various devices, POS devices, which they have installed. So it's not the entire merchant base. It's only calculated based on the number of devices installed. And these ticket sizes are closer to about 1.5 lakh kind of a ticket size. So as and when they actually pick up this segment, even this segment can contribute more to the loan distribution revenues. And of course, the take rates are around 4%. So yes, it can continue to drive the profitability as long as the lender is fine with the credit quality outcomes that they're seeing on the book, because Paytm is not taking any balance sheet risk, right? So yes, the lender has to be eventually comfortable with these kind of loans that Paytm is originating for them.
Okay. Are you sure that the loans that Paytm brings, more like a business correspondent to the bank, are safe? I mean, is this risk that the bank may face losses and stop connection with Paytm, is that risk all that palpable?
I mean, look, Lata, that is precisely what we highlighted in the front page of a report as the major risk. So Paytm doesn't carry any balance sheet risk or solvency risk, but Paytm carries a significant amount of business and reputation risk, and therefore it's like basically they're riding a tiger or they're running on a treadmill, right? So they have to keep delivering these stupendous numbers for their partners, quarter after quarter, month after month, and they cannot afford to have a blip. I mean, that's the challenge here, right, Lata? If you have your own balance sheet, you can afford a couple of quarters blip and resurrect yourself and come back. But if you're dependent on your partner's balance sheet, the partner is not going to give you a long leash of line. So to that extent, there is always going to be a significant business risk associated. As of now, considering the kind of penetration levels that we are seeing into the overall target customer base of Paytm, I think for the foreseeable future, the current trends could continue. That's the call that we have taken, and therefore eventually we'll end up upgrading the stock to an outperform.
Okay. No, I'll tell you why I'm concentrating on the merchant loans. This is something an insider explained, not insider from the company, somebody from the fintech industry explained to me, but I was not very sure what he's saying is right. What he was saying is that Paytm has a very good record of transactions for a merchant. You know how many people pay through Paytm. As well, they are able, I don't know if this is correct, they're able to escrow some of the payments that come through their payment mechanism, and so the chances of default are less. Is that the way to understand it?
Possibly, yes, on the merchant side. But remember, right now, if you look at it, 80% of the loans are personal loans, consumer loans, right? So, and that's where we have to be a bit more careful, because that's the one which is actually grown at a pretty furious pace. And that's where I think the risk could also be, in case obviously they are not able to adhere to the loss rates that the partner institutions would want.
Would you rely on their AI a lot? Since they have seen a lot of payments, maybe they choose their customers better or not so?
I mean, look, Lata, I mean, every fintech is saying we use AI, ML and stuff. So many fintechs have gone bankrupt in India, right? So,
okay.
I mean,
right.
across the world.
That.
So it's not,
okay.
I mean, just using an AI, ML and use those fancy language is not really going to help you. I mean, let's, to give credit where it is due, of course, they have a large ecosystem and they have a large network, both on the consumer as well as on the merchant front. And therefore, they have, of course, slightly at a higher competitive advantage compared to many of the other fintechs who grapple with scale, size issue. And one important point here, which I would like to differentiate between Paytm and others in terms of their strategy here, is a lot of fintechs in India, Lata, went into tenured loans, like a 3-month, 6-month, 9-month, 12-month loan on the balance sheet of theirs using FLDG structures. And clearly that went bankrupt. Paytm goes through the buy now, pay later loan. It's a shorter duration loans. You just test. Guys paying, then slowly graduate him into a personal loan category, right? So that's the approach. And because they have a wide network, they're able to do that. Others obviously went into a particular 6-month, 12-month higher ticket size loans, and they clearly didn't have the underwriting capability and eventually had to face huge losses.
So they have a better trick on personal loans, and it's possible that their merchant loans also is going to bring more business for them. Okay, the other thing I wanted to ask is their contribution margin. Now, for those who don't use this jargon, contribution margin is the selling price of a unit minus the variable cost per unit. You know, all the investments made divided by the transactions, that is the cost per transaction. If you minus it from the selling price, that's the contribution margin. Contribution margin has gone, has improved very well for Paytm. Is that sustainable, and why could they do that?
No, I'll be very honest, Lata. I mean, the way I look at it, and I'm a bit more traditional, I will never go by some of these techniques to look at it because they don't include a lot of expenses. Employee expenses obviously is never a part of contribution margin. At the end of the day, I need to see them delivering accounting profits. It's as simple as that, right? So currently the upgrade is also a function of the fact that at the time of initiation, we thought they won't make profits for the foreseeable future. As of now, in our model, they will make accounting profits as of FY26. And that's what is more important rather than looking at contribution margin. I'm going to look at the overall expenses and then see whether you're going to make accounting profits or not. So let's go by the traditional EPS measure rather than this convoluted adjusted EBITDA and adjusted EPS measures or adjusted contribution margin measures.
No, you also said that they have
accounting profit.
Yeah. No, you have said that they have controlled costs. So that's why I asked you that question. Just a final question, because that's the most relevant one. Today, there has been a block deal. Now, we still don't know whether it was any of the promoters or, private equity guys who sold it. We don't know anything. We only know that there has been a big block deal, and that has brought the share down about 6%. Is this an overhang?
Definitely. I mean, let's put it this way that Ant Financial, I don't know whether they are sellers today. I have no idea, but I'm just telling that Ant Financial and Alibaba, even after Alibaba actually having sold stake at the start of the year, hold together 28%. So that the Chinese controlled entities are controlling more than 25%. So that remains a significant overhang. SoftBank owns 12% or 12 or 13% after a 3% stake sale in post the IPO lock-in expiring. That's another 12-13%. So this will definitely remain an overhang to the extent of 40-41%. Some of these guys who are obviously been a part of Paytm for a very long period of time, I mean, they can very well come down. And specifically the Chinese companies, I mean, you know what is the thought process here of the government. There is definitely the selling pressure and overhang which can happen on Paytm. And that's a risk which every investor should be mindful of.
All right. We're out of time, but that was an interesting chat. Suresh Ganapathy, thank you very much for joining us.